My name is Christian, and I'm one of the co-founders of Norden Impact. And as the Norden Impact, we are a confluence of industry influencers, experts from the Nordic region, focusing on how can we drive climate science-backed technology and innovation for a global sustainability transition. So we try to connect the knowledge, the industry leaders and the academia together, and driving conversations such as the one we are hosting today, that is now live streamed to the AFRI stage at Almedalen. Together with us today, we have the four of you. We have Nora Bavey from Unconventional Ventures. I think I'll go a short round, and I'll actually let you introduce yourselves to give it a little bit more personal than me repeating your bio, I feel. We have Jessica Rameau from the Wellstreet investment fund, yes, who will highlight a little bit of the Nordic perspective on what ESG and impact investing is. We have Bilel Al Souaied, working with cybersecurity and previous experience of working with the Qatar Development Bank. And finally, we have Wonsik tuning in a little bit later all the way from South Korea. Glad that you could join us, Wonsik, who represents the D3 Jubilee Partners, a VC company focusing on impact venture capital. And I think it's going to be really, really interesting to see how the Nordic perspective that we are very, very much focused on actually compares to the perspective from the Middle East and Asia when it comes to venture capital. I'm thinking, could you just give me a short introduction of yourself to start us off? Yes.
Okay. Hi. Hi, everyone. I'm Jess. As Christian said, I work at Wellstreet. I'm a partner there and a fund manager. Quick intro on us. We are a Swedish VC firm based in Stockholm, investing across the Nordics. And we invest really early stage in companies, tech companies or tech-enabled companies. I think we've currently invested in about 30 companies. We are not an impact investor. However, we are very mindful of the companies that we invest in and the futures they create. And as part of that, we've created, I would say, a pretty comprehensive ESG framework for our companies to make sure that they are sustainable and the companies of tomorrow. So that's sort of the context from my perspective, I guess, and today.
Yeah, thank you. And I personally think that this in particular is a very, very interesting point based on some of the research that me and my team have been doing at the Royal Institute of Technology in Sweden, the KTH. And that idea is that the Swedish investors don't title themselves often as impact investors or investing in impact venture capitals. However, when we actually interview them and ask them about what are the criteria that you based your interviews on, and what does it actually mean for you to invest? Very much, majority of them could be seen as impact investors. And what is the distinction for you, and why do you think it is that Wellstreet invests as what internationally could be considered impact investors, but you would not title yourself as?
I mean, I don't think we would. So I think they're still very much sort of funds that are sort of defined as impact. And so the key difference being, impact funds invest in companies that have for purpose to create a positive impact, right? At the same time as they generate returns. And so sort of for 1 unit of returns generated, it's sort of 1 or more units of impact. That's not our objective. We're a commercial investor. And so we're focused on creating value essentially, and building businesses that create value and creating a return. And so I think that there is a distinction which is normally used with the word impact. Now that distinction exists in the regulation as well. If you look at the SFDR sort of defining sort of what an impact fund is and isn't versus what you might call an impact or sustainability conscious fund, then that gets categorized sort of more and more as we evolve and as the regulation takes place. And I would say like there's still very much like several sort of Nordic are sort of at their core impact and only invest in companies that have a positive impact. However, those rounds or those companies are often joined by non-impact VCs who still see a commercial opportunity in those companies, and of course are attracted by the impact side, but they won't invest just in impact. But the two types of investment firms tend to sort of co-invest together, which I think is really, really interesting. And then of course non-impact investors I think are still very conscious about the companies that they choose to fund, how those companies are run, and how at least they manage their negative impact as a starting point, and then maximize any opportunity for positive impact. And that's when you enter the sort of more ESG sphere as opposed to impact investment, at least in my view. So I think I would say most investors in the Nordics, would say or have the ambition to approach sustainability at least from a negative impact perspective, and make sure that that's managed so that the companies are sort of at net zero when it comes to impact. The difficulty, of course, is in implementation and sort of, first of all, transparency, management, implementation, and then actually being able to progress on the positive side towards that. But that would be how I would define the distinction, which perhaps sort of helps we frame this panel sort of in between the two. So I think the distinction is still very much still there. What I think a good way to sort of place it is more now both types of investors actually tend to invest in the same companies. So that's where this distinction happens. So there's an opportunity for non-impact investors to invest in impact companies as well.
Thank you for that, Jess. And I think this is a perfect segue to go over to Nora, because you would very much at Unconventional Ventures talk about the importance of that you can drive impact, drive a change through the companies that you invest in, but also through how those investments are actually done. Do you agree with just saying that it is still potentially a separate asset class that could be considered that the impact investing, but at the same time is becoming more generalized, that both the explicitly stated impact investors, but also non-impact investors are seeing more and more of a business case, investing into diverse teams, investing into climate tech, and so on?
Yes, and thank you for having me. So I run Unconventional Ventures, which is considered to be Europe's first impact fund with a diversity lens. So we are very much an impact investor. Not looking at the diversity lens, just looking at the impact lens, we are an Article 9 fund, meaning that we do have very high standards in terms of reporting. I would say the highest. And the reason for that is obviously if we distinguish the difference, as Jess was talking about, is that impact investors have to report on a lot of metrics, and it requires a lot of reporting. And the question that I battle with, as many are doing, is that how does that influence really early stage founders? Because we're also an early stage investor. So how does that influence the business model or the trajectory of that business case? But I would say how we are seeing it is that it's a competitive advantage to have, because they are solving problems that really need solving. So it's not nice to have, but need to have. And there isn't a commercial side to it. It's not one or the other. They are jointly combined. And that's why we're an impact investor and in the impact space. And the reason we're adding and I'd say adding because a lot of people from the outside see this as we're adding it. We're highlighting to make sure that people understand that we need as many perspectives as possible behind these solutions, so we can make sure that the problems that they're solving have a lot of creative ideas behind it as well from different perspectives. That's why we're highlighting diversity, because today it is a very homogeneous group of founders getting funded by investors, and they see diversity not part of impact, actually removing it and seeing it as more of a social aspect to the impact part, which drives me crazy, to be very transparent and honest. So that's how I would frame it and why we are doing it the way we are doing. And obviously this conversation is about how do we see that going forward, because there's a lot of things we should also be mindful of, that the taxonomy that is in place today is not updated for the world that we're facing today and will face in the next 5 to 10 years. On top of the taxonomy, the funds that are really out there are trying to do this. I mean, we're a first-time fund and a first-time fund managers, right? So our fund is a 30 million euro fund. The amount of things we need to go through are not adapted for small funds at this point either. So it's kind of limiting those very funds that want to back these incredible solutions in terms of what requirements does an impact investor need to meet. Oh, you're muted. Sorry.
Thank you. Thank you for that. And I think that comes a little bit as this the different in perspective, where at least in the Nordic, after interviewing a lot of founders, I think a lot of founders would agree with you that the investment itself and the profitability has nothing to do with whether it is an impact idea or not. We both saw a lot of the investors saying that because it is a sustainable idea, because it is an idea that is secured for the future and driving positive development, it will actually have less risk. It will actually be a more safe, more long-term stable, and more profitable investment to do over the long term. But then we also have a lot of investors that still see that that they might be a little bit different from the industry, that they themselves believe ESG is a little bit more important. But when we ask the Scandinavian VCs again and again, we often saw this same trend that we really didn't see in the same way when we spoke to investors from outside of Scandinavia, where it was very, very clear for them that it is a separate asset class that is interesting, that they are keeping an eye on, but it is separate from their traditional investors, where they would consider to commit 5% of their fund, for example, to this kind of investments. And I would wonder, Bilel, would you like to introduce yourself a little bit and tell us how did that perspective look like back when you were working with the development fund, and from your perspective today?
Well, thank you very much, Christian. Thank you very much, met my fellow panelists. Thank you for having me today. I'm quite delighted to be part of this panel. So as a quick introduction, today I'm the Chief Operating Officer of Cytomate. Cytomate is the first and only cybersecurity company in the entire MENA region that develops its own proprietary technology. And before that, I used to overlook deep tech and fintech investments within Qatar Development Bank. Qatar Development Bank is a developmental financial institution, was created in the latest of 90s with the sole aim of diversification of economic activity. As we progressed with time, we had an extensive portfolio of 145 companies. We had a dry powder of around $300 million that we invest directly through our balance sheets, and we had more than enough capital to be redirected toward impact and developmental purposes. Well, as the nature of a DFI, it's truly fascinating that they don't really look into profitability and from one side of the equation. But again, it's I mean, when we looked at investments, impact investment was seen as a fringe activity. I mean, it is often equated with philanthropy or corporate social responsibility. It was the focus was on doing good, and financial returns are often seen as a secondary or even unimportant. But this has significantly changed over the past 2 decades, at least on the life of the Qatar Development Bank. We now understand better that doing good and doing financially well are not mutually exclusive, that in fact they can be highly symbiotic. But if I were to analyze that shift, at least from the MENA perspective, because we kind of somehow still behind the trend for many obvious reasons, but the shift mainly was fueled by several factors. I mean, we investors realized that companies focusing on solving societal and environmental problems usually have significant market potential. This was coupled with emergence of a new generation of entrepreneurs who are keen of building businesses were not just profitable, but they were always purposeful too. The changing as well of consumer preferences on the other side of the equation also played a significant role in driving the investment activity. I mean, today's consumer are more informed, are more concerned about the societal and the environmental impact of the businesses. And so that somehow puts some pressure on companies to focus on more of the impact itself. But again, impact investing itself has both opportunities and challenges that can manifest in a lot of things down the line. You're unmuted again, Christian.
Mm-hmm. Yeah, I'm really happy to hear that, and of course, while this is not a race, we also all know that in a way this is a race. We all know that we need to see more VC capital. That has been one of the leading driving factors of technological development of the last couple of decades, to move towards sustainability, to move towards impact, and move towards climate solutions. However, Wonsik, you represent investment fund from Korea, from Asia, that focuses a lot on climate tech. But you also live in an environment where some of the social challenges that come with the digital era that we live in are more and more visible. And I think that is a very, very interesting case for you to work in the field where you can very, very directly see why those solutions you're developing are important. So please tell us a little bit about yourself and share what is your thoughts when it comes to your fund's mission, and how does that reflect on the society over in Korea?
Well, Christian, first of all, thanks for having me. My name is Wonsik Jeong, connecting from South Korea in Seoul. I work for D3 Jubilee Partners on Impact Venture Capital, 100% dedicated to impact funds. We focus on accessibility or climate tech startups from Series A to Series B, mainly in Korea. And just briefly introducing what's going on in Korea in terms of impact investment and climate tech investment. Korea, the impact investment is, I would say, it's still in very early stage. I think the market started in 2018 from the support of government. So because like the whole market is actually driven by government support. Actually, the VC market itself was also initiated by government support from decades ago. And from 2017, the government started to be fund of funds for impact funds. So that's where we start to have impact funds more than like tens of millions. And because the period of fund is 7 to 8 years, we have not yet proven the profitability and impact of impact funds. So, and majority of mature impact startups in Korea are now at stage B, Series B. So I think we are in the kind of transition period for both of impact business and impact investment as well. But I see, even though the impact investment is still in early stage, I think the climate tech investment is becoming huge in Korea because all the conglomerates, the big corporates are like global manufacturing companies like Samsung, LG, and Hyundai. And I think they are, from last year, especially when Europe and US start to regulate and support the climate tech a lot, I think the majority of the conglomerates are very much threatened by the fear of losing their market if they don't do the climate transition right now. So all the conglomerates are making their corporate VC and really too much focusing on climate thing now. So all the impact venture capital and corporate VC and corporates are too much focusing on climate. And at the same time, we have severe social issues, and none of us are focusing on social issues right now. So personally, what excited me recently is my company is trying to launch an impact fund for a population issue in Korea. Korea has very severe social problems in this issue, from the disappearance of local cities, so the capital centralizations, to the lowest birth rate in the world, sadly, and the aging populations, etc., etc. So we are trying to launch this fund early next year, and I think it's going to be more meaningful because even among the impact VCs, none of us are really raising issues on social issues right now.
Well, the social and the impact VCs are, for many, part of the same space, and I think, Nora, you would agree very much on that. But then we also, of course, see that predominantly when people say impact venture capital, they think clean tech, they think green tech. That was a huge wave between 2006 and 2011. And I think a lot of the impact-based current image got to take a step back after the investment into the green tech space slowed down a lot. And then we saw just last year what happened in the VC space as a whole. So what's happening now in 2023 is actually really, really fascinating to me, because I would say that I almost see it as a rebirth of what impact venture capital investment is. I see a lot of the Swedish perspective or the Scandinavian perspective, where we invest in companies that are more sustainable, that are going to be able to survive downturns like the ones that we've been seeing now over the last couple of years. And then impact investment just aligns perfectly well with the investment that will expectedly be the more profitable as well. But Nora, if you would like to take over and continue on the topic that Wonsik lifted about the social investment, the environment and climate tech, and how is it aligned with the VC space as a whole? Do you see that there is a movement towards this, or how does it look like from your perspective?
Well, as I'm here during Almedalen political week for the first time in many years, I realized that I was right in 2018. And it's so sad to say that. We're so falling behind that it literally saddens me, to be honest. I think we think that we are moving in a much faster pace. We've been very proud and living off of old merits. What is the topic of this week? You have security, cybersecurity, and you have AI. These are not conversations we should have in 2023. These are conversations that should have been made many years ago. And have been made. So in 2023, we should be focusing on, so how do we speed things up, right? How do we manage to measure things that really can have a true impact? And the byproduct of that is obviously financial returns. So I think that I would love to, in the whole impact space, be more aligned. I think that because I fear the many silos that exist within this space, and the very reason why impact investing exists is because of what Bilel and obviously Jeong mentioned, was that it really started from a CSR or even from another perspective, that this was not equally equitable, scalable growth opportunities presented for the VC space. And if you look at the VC space for the last 20 years, and obviously with everything that is going on during these 20 years, what we should have learned is really that we need to speed up and focus on solving problems that are global that everyone can address to, right? And if you look at in the impact space, I mean, environmental and social, those things also creating silos, because environmental should also be access to healthcare, access to education, access to, but we kind of put it in the social aspect, and the taxonomy follows that. So it makes it, easier to focus on climate. But then the question is, whose climate, right? At what part of the world are we focusing on what things? So I think we need to be very transparent and honest and have those conversations in between us. But I think us working in silos is creating a narrative where we will never be able to change the taxonomy to be that be up to speed to what the industry is doing and where this is going. And my hope is that, obviously, I had a conversation with another VC that said that the deal flow is too small when it comes to impact. And that literally surprised me in not a positive way, because I'm like, where have you been for the last 5 years? If you feel like the pipeline for impact deals are too small, that says a lot about where money is being injected into what. If we look at in terms of impact, what are the problems we desperately need to solve? And 2030 is literally around the corner, and we're not going to make those ambitious goals. So who's responsible is that, right? And that's where the capital comes in, where we need to create, even more of an ecosystem with full transparency, where the transparency is in also admitting what barriers lies for impact investing for those that want to direct capital into this.
Bilel, did you have a comment on that?
Actually, I can hardly relate to what Nora was presenting. Well, one of the most prominent challenges for impact investing per se is the measurement and quantification of the social or environmental impact that you're going to put. Back in Qatar Development Bank, we had a struggle of quantifying the impact on the Qatari economy, on the Qatari community. How does an investment in a fintech or health tech contribute to the impact, and how does a dollar spent on healthcare has more impact than a dollar spent on a fintech? So in the end of the day, the capital in nature is scarce, and well, we're lucky because we were backed by the government, so there was no pressure on how we spend those dollars. But can you imagine an LP being there trying to take sides or trying to trying to choose the side of the trade-off? I mean, unlike financial returns, which have long established, universally recognized metrics. Now we have IRRs, we have NPVs, we have margins, but it's really hard to have a social and impact measure to cross compare deal flow, or actually to cross compare the viability of these projects from one side of it. From climate change, I mean the issues that we face today are quite diversified. I mean, we have a climate change, we have biodiversity loss, we have socioeconomic inequality, we have education problems, we have healthcare. So it's challenging to come up with a universal metric that can adequately capture an impact across various domains. I mean, how would you compare an impact of a company reducing carbon emissions with I don't know, with a company improving educational outcomes in underserved communities? So these are questions has to be tackled in one way. So there was some sort of there was some sort of efforts towards that direction. I mean, many organizations and initiatives are working to develop standardized measurements and reporting frameworks. We have, for example, the Global Impact Investor Network. Well, together with Management Project, an organization as well, are promising to deliver on that direction. But even with these tools, it requires significant level of expertise to understand and apply these metrics, and you need to have highly conscious LPs that are willing to at least to look at the long run rather than short-term gains. Well, it really also differs a lot between the early stage investors and late stage investors. I mean, the early stage investor has a breadth to incorporate all of these knowledge and impact back to the business in a spare time between 7 and 10 years. But if you're talking about a later stage VC or early stage of private equity transactions, it's a bit uncommon for them to incorporate those models down that line. I mean, there's always a challenge in balancing financial returns and social environmental impact. The perception of trade-off between these two has been long-standing debate of impact investing world since 20 or 30 years to come. It's increasingly becoming highly debatable too, as it's a false dichotomy. But I mean, with plenty of examples of successful impact investments. But the real question that LPs are looking to answer today is that will the statistics prevail if we have a robust framework for both VCs and entrepreneurs? Because we do have today with some really good examples of impact deals that have delivered high returns, and they were aligned with the fund, and they were aligned both with the impact as well. But again, we don't have enough data to cross compare those on a statistic modeling level.
Yes, I think you're touching upon quite a few really crucial points, and I'm thinking just you would be probably the perfect person to answer up and follow up on a few of those. You touched upon the fact of that the VCs actually have a responsibility towards the startups and towards the future that they are contributing to and funneling the money towards. And this is something that we saw was very prevalent with a lot of the Scandinavian Nordic VCs that said, yeah, well, I believe everything I invest in could be considered an impact investment, not because it necessarily is an impact business I invest in, but because when we invest into those businesses, we ask them questions that align them with the ESG goals, and thereby making that business more sustainable and more profitable in long term compared to its competition. But Jess, would you like to elaborate a little bit on that? How do you speak to your LPs? How do you build the case for ESG-driven businesses? And how does the mindset that you have at Wellstreet actually shape the way that you invest the capital? Because I think your approach could be much more inclusive for a lot of VCs across the globe to incorporate.
Yeah, and I think so from our perspective, then we're approaching it from a survival and competitive aspect. Like, we want to create the businesses that will exist in the world of tomorrow, and I think we don't believe that companies that aren't sustainable, that can't sort of run in a way that is sustainable should exist, and therefore they shouldn't be funded. So everything that we choose to fund is a choice on the world that we're creating, and we actually have an incredible amount of power. Probably not us, we have a very small fund, but in general, if you look at the VC capital and the decisions that have been made and the impact that has. So I think it's really important to bear that in mind, that it's always a choice that we decide to fund a company over another, and each company we give them sort of power to be part of the world and to create value. So I think, and that's basically the purpose of the SFDR, which is then the EU regulation. So I don't know if Bilel and Wonsik, you're familiar with it, but actually SFDR is about redirecting capital flows to more sort of sustainable solutions. So it's about sustainable financing versus creating impact companies, which is an important distinction, I think. So for us, our perspective is it's not about funding impact product and services that have a positive impact. It's about creating sustainable businesses. So instead of looking at it just from the perspective of, this company provides healthcare, or this company helps companies calculate greenhouse gas emissions, this company as a business has good governance in place, is responsible in the way that it hires and looks after its people, takes care of its customers, has created a product life cycle within the design that means that product is sustainable or doesn't create waste, right? So in every single aspect or pillar of the business, whether or not that business is qualified as impact, how we define it at the beginning, that the business sort of can and should be sustainable, which from our perspective then should apply to all companies, regardless of what it is that they're putting out into the world. So that's kind of the premise of it, which is, I think, a little bit different from an impact fund or from the solutions that Nora's fund invests in. Although I'm sure they sort of have the ESG as the basis. So and impact companies, should have the same. By the way, like it's not because a company has created a service that is due to create impact that from an ESG perspective it's doing the right things. Those are sort of to be distinguished. So I think that's really important. I wanted to touch on a couple of the things that were brought up in the panel. I think there's a really interesting theme here around. I mean, Nora, you mentioned sort of pipeline and deal flow, and funds saying, there isn't deal flow to refulfill, and I think that's unfortunately due to how VC or venture capital has been perceived and is expected to perform, right? The level of returns that people are expecting based on actually very, very few cases that are perhaps sort of out of the ordinary. The expectations in terms of returns on venture capital are 10-time return is sort of typically what people say. So that's one part. And also you are, at least in Europe, and I'd be interested to hear if it's the same in other geographies, but you also have funds that are being raised that are getting bigger and bigger and bigger. So bigger funds are being raised with companies saying at the same time that they're investing in very early stages. Those two things don't really go together. The bigger funds are raised, the bigger you raise the stakes. And the bigger you raise the stakes, the smaller amount of companies actually have the potential to make that return. And so you're placing a really, really big ask on impact companies. And so you really need companies that are using technology to have that impact, which is why climate tech, green tech on the environmental side, or healthcare and health tech have been the prominent ones. Sometimes it's not just a question of technology or access. Sometimes there are, societal problems that we're trying to deal with that can't be solved by technology. And so actually my personal opinion is that doesn't necessarily belong in venture capital. I think that there's other ways to solve problems. Sometimes they're societal, sometimes they're political. And so those are not necessarily sort of the right avenue for VC capital, whether it's sustainable or not, if you know what I mean. So I think, like, in a way, perhaps if there's a readjustment in the expectations of the types of returns venture capital should deliver, which I think we're seeing now, then you might have actually a perception of companies that qualify broaden, and so funding hopefully unlocking for some more companies that perhaps haven't had access to that type of capital before. So I think it'd be interesting to see how that evolves. I don't know if you agree, Nora, or if I'm off here, but do you see what I mean? Because it's always judged by potential of return, which can be really difficult given sort of the high stakes that have been created by, again, very, very few cases really out there.
Well, Christian, you're back on mute again, in case you're wondering.
So, Nora, I'll let you comment on that, and then I think in Wonsik you can follow up on your perspective, as it was also mentioned, if there's any difference from how it is seen from Korea. So, Nora, thank you.
No, Jess, I love that you brought up the VC model and from an impact perspective, because one thing that I absolutely would love to address more, which we don't do enough, is that how sustainable is the VC model, right? Saying that becoming a VC is really always fun. But I think some of the parts as well that Jess mentioned is that if we're really then going back to understanding what happened in the industry and what route and for what reason, we never talk about that. The simplicity of the model is that it got its foundation from a period of time when we had things like, I know Wellstreet works very well with these called dirty terms, right? Where you had VCs taking huge equity shares at early stages at company. So these 10 to 20 to 50 exits, those are also like a false statement, because those were being created during a time where you could invest a $500,000 euro ticket or dollar, because I'm referring to the US market right now particularly, but where you could invest $500,000 and take quite a big chunk of equity, 20-30% at early stages. And that is kind of cemented its way now. And I'm trying to unlearn, because cementing, I learned from another impact investor, is not words matter. But it also cemented the whole the venture model of returns and how to calculate returns. So I think that's also up for debate, where we should talk about. And I think when we have those hard conversations, then we're going back to the same thing. What things do we need to update in our models, in the way we look at what to invest in, how to invest, and how that will reflect the performance and what kind of performance we will see?
Should I continue?
Yes, please, Wonsik, because it was mentioned that your fund works with your work with the relatively early stage businesses as well. So yeah, I'll let you take over.
I'll point out first about the impact communication first, and then I want to also address something about the VC model on impact. So first thing about the communications, actually, I think because we are still in early stage of impact investment, we do publish impact report, and we do quarterly share the impact KPI and business KPI to LP, and we are also developing our software to do it more in better way. But I think in terms of impact communications, I think we are focusing only one thing, which is just impact KPI for now, because we are doing thematic investment. Because we are investing in early stage startups, we are not asking startups to measure everything about ESG. We just ask them, we just communicate well to define together one single impact KPI to follow on in the long term, but it can be changed when it's necessary to change. So by doing that, we hope we just want to make sure they follow the impact journey together with impact investors. And we quarterly report this impact KPI to our LPs. And I think as the liquidation of the impact funds in Korea is a few years away, I think more and more the impact communication will be important in a few years. And talking about the fundamental questions about VC or impact VC model on making impact, I think definitely we need a bigger, like mainstream impact, like large scale impact funds in climate tech and healthcare. But I think Korea has like generous social impact funds, generous climate tech funds, and general LP. I think impact VC also need innovations in our fund structures and how, like, I think we need to be more social problem solvers as well. For example, I think our funds should be, at least in Korea, it's too general. It should be more sophisticated. We should have more specific problems that funds want to solve, and maybe to make macro impact, and inviting like the very specific LPs who are involved in that issue and who have interest in that issue. For example, I mentioned about the population impact fund, and we are focusing on one kind of methodology, which is called a place-based impact investment, PBII. And so we set out one region that we want to tackle about the problem of local city disappearance, because we set one city and we define what like very specific problem there. We're inviting a very specific public and private LP around the problem in that region. And we also putting in the SIB there, like social impact bonds. I think it's just one simple example, but I think we need to diversify our fund approach as well to tackle a lot of social problems. You're muted
Christian,
again.
you're mute again.
I think that's a very interesting point, especially as we are now talking about both the more Scandinavian model, where it is like all our investments are in some ways an impact investment because they align with ESG, but also how do we actually leverage specialized LPs? How do we actually leverage specialized funds that can create internal synergies, right? To drive faster change. I know, Jessica, that you have a hard stop. So I'm thinking we'll do a little lightning round now, Jess, if you would like to start. So there are two short questions. One of them is, what is your best advice for people here looking at impact investment, or maybe wanting to pitch in investment? Like how do you communicate this impact edge for LPs? What have you felt has been the most efficient way? So if you can give one advice, one tip on communicating impact venture capital, like the impact edge, as we call it, and also just one thought on what lies ahead of us. What lies ahead for impact VC, from your perspective, of course?
I think so. On the first one, I think from a communication perspective, I don't know. I think the most important thing is to be as a company honest about what your goals are, what you want to achieve as a company, and then obviously communicate that as transparently as possible. And as we all know, and at least from a European regulation perspective, like the era of greenwashing is over. So what are your objectives, what are your goals, and how you hope to achieve that. For us, the way we approach it is very core to our DNA. We're company builders, and so we work on ESG the same way we work with all of the fundamental pillars of a company, and sort of within those, whether we're looking at product commercialization or hiring teams, ESG sits within all of that, and so that's what we communicate. But I think that the most important part is for it to be sort of authentic in terms of how it's actually approached internally. In terms of what lies ahead, I think at least in the Nordics and in Europe, that it will continue to sort of be blended. I think when it comes to non-impact VCs investing in more impact companies, I do think unfortunately that impact investments at least at scale will remain on the climate side or the health side and things we've seen more. I think it's going to get a little bit more difficult from a conflict of interest perspective to generate those levels of revenue that VCs expect on some of the more perhaps social issues, unless we recalibrate the VC model. And then I think another trend that I'm seeing is that actually impact VCs, who are traditionally have been real impact, are starting to get sort of more and more niche, or more and more sort of hardcore around impact, as sort of the general non-VC is moving into impact. They're sort of moving further in with sort of more specialist funds looking sort of into deep tech and those sorts of things. So that's my predictions. I'm going to dial out. I'm really sorry, but thank you so much for having me. I look forward to meeting all of you again soon in another setting.
Thank you so much, Jess. Was really, really nice to have you join, and I'm really, really happy to bring with me the statement you had earlier about everything we choose to fund is a choice. It's always a choice to decide to fund a company. So thank you once again, and then I will continue with you, Bilel. What are your thoughts on maybe something you've picked up from this conversation, or something that you've seen worked in the MENA market when it comes to communicating impact venture capital, and what do you think lies ahead for the MENA market and impact venture capital there?
Well, actually circling back to the VC model that we discussed a bit earlier, I think most of the VCs and entrepreneurs and even LPs themselves tend to forget that out of the 20 deals that you might have 2 home runs, 3 or 4 might return 1x, and the rest will be complete write-offs. So even if you do impact investing and it fails off, that would be a significant contribution to the economy in decreasing the cost of the opportunity to reinitiate that project in another form in another day. So you don't have to be 100% impact washed fund, but you can be completely generalist fund that does impact investing and still maintain balanced relationship and balanced transparent relationship with their LPs. Actually, the quick example on that, in Qatar, we just recently launched something called Unconventional Ventures. Unconventional Ventures is the true manifestation of what we spoke a bit today. So it's a generalist fund, but they don't label themselves as an impact fund, but they try to find deals where both the impact and the viability of the project both are symbiotic relationship. That's my first thought. The second thought that I would actually say is that for early stage investors, they have an opportunity to embed impact or sustainable business models in the long run in a way that they cannot steer away from it in 7 or 10 years. I mean, the classic exit strategies that we see today, either through an acquisition or even an IPO, may not actually guarantee that sustainability of the models post exit. I mean, they may not share the same mission, they may not share the same values, so they have both the pressures over either from the parent company or the market itself to look more into the profitable business model, or at least classic business models, so that they have to do so. So VCs should bear responsibility in taking that torch and embedding that impact within the business model. My third and my last thought as well is that there was a lot of industries where it wasn't labeled as a venture capital deal, for example, plant food based or even solar energy, but there's still venture capitals tapped into it and had an economies of scale for these companies to make better products cheaply and distribute it across regions. And then now we have better alternative energy resources. We have better food choices, thanks to a lot of capital has been directed to decrease that risk in the long run. So one way or another, collectively as VCs, that can happen, but individually, I don't see that happening, unfortunately. So some form of coordination has to happen. Some form of framework has to happen. Well, I'm personally rooting for the European and the American markets to lead the way, because from our perspective, still that's still a bit 10 years late to the party.
Mm-hmm. And what do you think lies ahead? Do you think you will wait for the EU to come with a stronger taxonomy and then tag along, or do you think MENA, or do you see that MENA is developing their own approach to impact venture capital through the new venture studios as the one that you just mentioned?
Well, for the MENA region per se, so now actually we share most of the world challenges in implementing the impact plus our own challenges. So, but we do have a lot of opportunities that we can do and a lot of things that VCs can capitalize on. I mean, we do have a demographic advantage. I mean, we have more than the 60 or 70% of our population is actually below 30, which can fuel a generation of small medium-sized enterprises with a mission. We have a lot of capital laying around that has been used effectively. It can be used to support the ecosystem in a manner that can grow sustainably in the long run. We can develop a lot of frameworks in the region that can be used by both sides of the equation, both consumers and both investors, or even the three ways of the equation, and entrepreneurs, to build more sustainable companies, a more sustainable environment. Challenges do exist, and challenges will always exist in this space. Is that we need to make these challenges less hard to overcome with time. That's what I believe in.
Well, I'm also excited to see more of that developments happening, and I can't wait to hear. Nora, do you have any comments on the statements by Jess and Bilel, and after that, your own advice when it comes to how do you pitch the impact edge, and how do you see the coming development of the sector and industry as a whole?
Well, I mean, I do agree with Jess and Bilel. They've already touched upon just the future and the frameworks of impact investing. But I mean, as a person that talks to LPs literally every week and every day now, and had gone through 4 years of getting to a point where we could raise the actual fund and having this conversation ongoing for 4 years, I think it is good to be reminded that it's still in the early stages. But I would really leave this conversation with that we don't have time to waste. So that's kind of my last sentence in terms of we always talk about first mover advantage for founders and what they should focus on, and I kind of want to implement the same with impact investors in terms of how quickly can we jointly decide on a very few things where those enables us to run, not crawl or walk, run in this space.
You're on mute again, Christian.
I fully agree. I fully agree. I don't even. I really look forward to seeing that as well, and I'll let Wonsik to follow up and say how do you piece this together? Because I mean, you have the fund that you were mentioning that you're looking at with a more social stance, but at the same time, it is much more focused. Something that Bilel also commented on, stating that like our way moving forward is maybe not specialized impact funds. It is more generalist funds that are also realizing that we need to invest into more sustainable ventures that will also be able to create more positive impact, but also feel slightly less bad if they don't work out. And this is something that we saw in a lot of our work and a lot of our interviews, that a lot of the investors stated that it also simply feels better and more safe, that knowing that, of course, not every single one of the investments will work out, but every single one of those investments that they do is meaningful.
Well, Christian, could you repeat your question again? Sorry.
Yeah, so yes. So the key question is, how is your fund currently communicating when you're speaking to, for example, LPs and so on? You touched a little bit upon it, but if you would want to follow up, what do you believe has worked this best when you speak to and communicate impact investment and climate tech in Asia, in Korea? And then finally, what do you think lies ahead? You mentioned a little bit, but I'd love to hear you elaborate a little bit more on if you see that there are some more emerging trends, and how do you feel that the big conglomerates will interact with, for example, your fund?
Okay, so I think more sharing about what's going on in Korea. So as I said, our funds are so much dependent on government support. So majority are so far government. So like there are not many private LPs like conglomerates who are putting their money in impact funds, except climate tech. So I think it's again like we need time to prove the profitability, and to do so, I think one of the issues we are facing now is about how do you say I forgot the secondary markets. So because like all the very first impact funds are 3 or 4 years away to liquidations, I think like all of us are looking for how we got connected to secondary funds, and that's I think because not many of the social businesses are successfully IPO or M&A'd. So I think like we are in the transition time to really prove the profitability, and I think in terms of conglomerates, I think that until last year, everyone talked about ESG, like every personnel, every conglomerate, every company. But now, as the economy becomes not good as much as last year, like now no one really talks about ESG, and I think I see there's a kind of FOMO from the global perspective. Like we hasn't successfully done the internalization of either ESG or impact. So I think, so because of that, I think even impact funds have more crucial role to really prove our very first impact funds, both the profitability and impact. So yeah, it's just general thing, but I just want to say Korea is really in the very important transition period to either make good transition or not.
Well, thank you for sharing that, and I think it is a hard situation to be when the majority of the capital comes from the government, and that the actual bodies such as the conglomerates in Korea are only interested in then very specified funds, and that then it makes sense that you are really trying to create a package for them that is attractive. And this is something that I'm sure Nora, Jess, and Bilel, every fund really strives to do in one way or another. That said, I'm thinking thank you so much for joining so far.